Welcome to the Runway, where we cover current events in crypto, Web3, and tech. Today's Runway looks at the Keep Your Coins Act, recent headlines from market players like BlackRock, MicroStrategy, Tether, and JP Morgan, while also exploring macro trends, Twitter takes with commentary, opinions, and analysis from yours truly. It's Monday, November 13th. Let's take off. Senator Ted Budd introduces Keep Your Coins Act. This initiative seeks to uphold the independence of cryptocurrency users and protect their capacity to personally safeguard digital assets. This legislative proposal, which comes after last year's FTX exchange collapse, seeks to protect individuals' rights to conduct cryptocurrency transactions without relying on third-party intermediaries, which is pretty much what crypto is all about. This legislation aims to protect individuals' right to self-custody Bitcoin and other cryptocurrencies, effectively allowing them to conduct transactions without needing third-party intermediaries. This development comes after last year's FTX exchange collapse, which exposed vulnerabilities in centralized custody systems. If passed into the law, the legislation would empower cryptocurrency users by allowing them to maintain custody of digital assets in self-hosted wallets. It prohibits any federal agency from proposing rules that hinder an individual's capacity to act as a self-custodian of digital assets. Senator Budd emphasized the importance of this legislation, slating, "As consumers face new challenges and risks associated with the use of digital currencies, we should be empowering individuals to maintain control over their own digital assets. This approach will foster financial freedom in a more decentralized cryptocurrency ecosystem." You're definitely a Bud. Congressman Davidson, Keep Your Coins Act. It looks like, meanwhile, in July, Representative Warren Davidson saw the U.S. House Committee on Financial Services pass the Keep Your Coins Act of 2023, a bill he sponsored. Davidson's legislation primarily focused on preventing government agencies from imposing regulations that would require the use of third-party custodians for digital wallets. Davidson has been vocal about his support for self-custody, stating on X, "Anyone attacking self-custody is telling you they oppose individual freedom. They don't trust you, and they want someone who they can control to control your assets. They want someone who they can control to control your assets. Pass my Keep Your Coins Act to protect self-custody and defend freedom." It's looking like this made its way through Congress, and now it's in the Senate. He's seeing Elizabeth Warren here, which is a classic. He added, "Self-custody is the antidote to FTX's fraud, and my Keep Your Coins Act would protect self-custody from misguided attempts to restrict it." While Senator Budd's proposal gains momentum, it faces opposition. Senator Elizabeth Warren filed her bill last year, taking a different approach. Warren aimed to limit cryptocurrency self-custody, specifically non-hosted or self-custody wallets. She sought to require platforms and networks to identify and trace transactions involving such wallets. Notably, the Financial Crimes Enforcement Network has previously recommended similar regulations, but they have yet to be enacted. A quick overview of this, usually it's sad to see Miss Warren on just the wrong side of this issue. This is something that empowers people's freedoms and people's rights, and it's already sort of protected in our Constitution with our rights. And she's constantly on the wrong side of this issue. And it sounds like she really hasn't done her homework and educated herself on all of this. But usually, this sort of protects the little guy. It allows the little guy to custody their own assets and not be at the boot or the whim of huge centralized entities like FTX. So I think this is great that it's making it through Congress. It's nice to see some positive legislation from Mr. Ted Budd here, and also from Warren Davidson. Let's hope that we see more protections for the individual and for the average user, more liberties be protected here, and hopefully this works out. Let's proceed to our next story here. And we discussed this a little bit last week. BlackRock filing Spurs Ether rally as ETF bets fire up crypto. ETFs that hold Bitcoin or Ether don't currently trade in US. Other issuers have already filed for spot Ether products. So it looks like it's officially, I think there was a little error in the title. What has been officially confirmed here is that the fact that BlackRock has made the filing for this Ether ETF on the back of their Bitcoin ETF filing. The iShares Ethereum Trust has just been registered in Delaware. For context, BlackRock's iShares Bitcoin Trust was registered in a similar manner 7 days before they filed the ETF application with the SEC. No big surprise here that one of the largest financial entities on earth is going to want to make an ETF for the second largest crypto asset in addition to the first. And there's also lots of interesting possibilities there for participating in network consensus with their proof of stake network, and an ETF can essentially provide that security to the network, the underlying funds of Ethereum in that ETF, and might potentially even be able to pass on some of that revenue to customers and people who hold the ETF. Interesting. Let's move on here. We have another story. So full disclosure, I am an investor and holder of MicroStrategy, the stock, and it is a big part of my portfolio. Michael Saylor's massive Bitcoin bet crosses $1 billion in unrealized profit. So kind of just talks about Saylor's software company, which is also a profitable company. Essentially, it's a profitable software company, and it's been around for many years. And he basically just has tons of Bitcoin on the balance sheet. So it's pretty much the closest thing that individuals in society currently has to a Bitcoin ETF, essentially. So it's basically a profitable software company that just is holding a massive amount of Bitcoin, 158,000 Bitcoins in their portfolio, just as an asset on their balance sheet. When this article was published, they were up, over unrealized gains of over $1 billion of fiat. Let's move on here. Stablecoin issuer Tether has been increasingly minting new USDT, issuing 4 million USDT over the past month. 4 million USDT is not much in the grand scheme. It's actually 4 billion. So just a little minor typo there in the Cointelegraph article. Major stablecoin issuer Tether has been increasingly minting new USDT tokens, issuing 4 billion USDT over the past month. Tether issued another 1 billion of Tether on the Tron blockchain on November 10th, blockchain data provider Whale Alert reported. The latest USDT minting came just a few days after Tether issued another 1 billion USDT on Ethereum on November 9th. In addition to 2 billion USDT issued in 2 batches on the Tron blockchain on November 3rd and October 19th, according to Whale Alert data. Tether Chief Technology Officer and new CEO Paulo Arduino commented on Whale Alert data on X, noting the latest 1 billion USDT transaction on the Tron network was a USDT inventory replenish. One thing to sort of note from this article that I got out of it is that you're not just seeing this being launched on Ethereum. We're also seeing a lot of activity on Tron's blockchain and other smart contract platforms. Tron is very popular in Asia, in Korea, and China and Hong Kong and the sort of Asian Pacific. So we're seeing buying pressure and interest in crypto and Web3 coming from the other side of the world, and not just the US, right? So this is a large global market. JP Morgan adds Holy Grail payments feature as part of blockchain push. JP Morgan is giving institutional clients more control over payments via JPM coin, marking the company's latest blockchain-related milestone. Siemens, the first to use the new offering, built to allow a real-time and a programmable treasury. Its new programmable payments offering is a feature for blockchain-based accounts on the JPM coin system, a permissioned payment rail and deposit account ledger, letting clients transfer dollars within the system. Programmability lets clients place rules for funding a bank account, for example, or set parameters for executing payments based on margin calls, asset delivery, or meeting contract requirements. Blockchain technology is the ideal infrastructure to which programmable payments can be applied, as it enables rules and bank accounts to be integrated in a native manner, enabling cases including dynamic direct debits and multi-party escrow accounts, a spokesperson told BlackRock's in an email. JP Morgan's Onyx Digital Assets Network, launched in 2020, enables the tokenization of traditional assets such as U.S. Treasuries and money market products. The company tested programmable payments with German automation company Siemens in December 2021, calling it a move that will forever redefine the role of corporate treasuries. Siemens made its first payment with the programmable capability on November 6th. Advantages and features from the crypto world are now available for fiat currencies by JP Morgan's provision of 24 hours by 7 days blockchain-based bank accounts, combined with programmability, Siemens Group Treasurer Peter Rathgeb said in a Friday statement. JP Morgan has been busy on the blockchain front. The financial titan used a Polygon blockchain to trade tokenized cash deposits in November 2022. More recently, asset manager BlackRock last used JP Morgan's tokenized collateral network to tokenize shares in one of its money market funds. It then sent those interests to Barclays as collateral for an over-the-counter OTC derivatives trade between the firms. BlackRock CEO Larry Fink said last year, the tokenization of securities is the next generation for markets. So I think this is an important development to follow. I think it largely goes in with the larger macro sort of theme here, leading into the next sort of market cycle of the idea of real world assets being tokenized and put on chain. And I think there's going to be public chains like Ethereum and Polygon. And there's also going to be private chains, like private blockchains between banks that they use for settlement and sort of to gain the features of sort of a fast moving, transparent system between counterparties that may not necessarily have the same benefits like decentralization that public blockchains have, right? So I expect this trend to largely continue into the future. Let's move on to our next story. Singapore-based cryptocurrency lender Hodlnaut will be liquidated, according to the company's former interim judicial managers Aaron Lee and Angela E. A winding up order was filed on November 10th with the High Court of Singapore. Liquidators will continue to provide updates to the exchange's creditors, of which there are more than 17,000. Hodl applied for creditor protection last year after suffering around $189 million in losses due to the Taro ecosystem exposure, which collapsed in May 2022. The lender also had $13.3 million worth of crypto locked on FTX before the exchange froze withdrawals and ultimately filed for bankruptcy last November. Hodl creditors rejected a restructuring plan earlier this year, favoring liquidation as it would better serve their interests. Aaron Lee and Angela E. have now been appointed as liquidators of Hodl, which will be wound up under the Insolvency Restructuring and Dissolution Act of 2018. The winding up application was filed in May this year and approved on Friday. A quick little story here. I think this is just good for the space. We're seeing a lot of bad players or failed players from previous market cycles. There's no bailouts in crypto, and the U.S. taxpayer isn't coming to save these different companies, whether they be in the U.S. or not. We're sort of seeing the undergrowth being burned off, which will allow sunlight to sort of come through and grow the next generation of better companies, and the ones that can grow and last a long time will be battle tested and tried in the markets, right? So I think this is largely good for the system. Let's clear out a lot of the stuff, and we really don't see a lot of this in the traditional financial system. A lot of these companies are zombie companies that have been surviving off of interest rates, super low interest rates, being able to get essentially debt for near nothing. The companies make near nothing, and they can just sort of survive as zombies and just sort of suck up capital that really should go to more productive companies in society. So largely good for the crypto space. We have true price discovery. Web3 doesn't really mess around. If you're a bad player, you will get weeded out. You might be able to last a little while, but these scams always do quickly, much more quickly, come to an end as opposed to more traditional financial scams. For example, Bernie Madoff hung around for, I feel like, over a decade, maybe. And we see some of this stuff. They last one market cycle, a year, 2 years. And then, if they are not a legitimate product and they don't satisfy customers and they're not solvent, they quickly burn themselves out and go away. And, hopefully we can welcome much better operators and companies into the space for the next cycle. And, let's give credit where credit's due to good actors like Coinbase, who are now currently being attacked by our own government. Next up, we have another look at some legislation, and we talked a little about this a little bit last week. The IRS is raided, choice of words there, raided by crypto investors as industry puts up fight against U.S. tax proposal. The proposal to establish a U.S. tax regime for digital assets has drawn a stunning 120,000 comments and will be the focus of an IRS hearing today. The Internal Revenue Service's audio-only hearing today will draw views from the crypto industry on what threats the digital assets advocates see embedded in the proposed new tax approach being contemplated for cryptocurrencies. The concerns include user privacy, the scope of crypto entities that would have to report transaction information, the inclusion of stablecoins, and whether the proposal implies anything about whether digital assets should be counted as securities. The U.S. Internal Revenue Service is gathering the final words now from a crypto sector that is arguing the agency's proposal for a digital assets taxation regime is an existential threat to investor privacy and to decentralized crypto projects. Some of the main issue is around what entities are actually brokers in the traditional sense, and I think there's a lot of pushback from the industry on this. Monday's hearing, confined to audio, will gather prominent crypto advocates to lay out their arguments on this proposal that maps out how crypto brokers and investors would report transactions to the IRS. The new taxation system, which won't become final until IRS officials weigh the input, rewrite a final version and approve it, has drawn industry ire that's partially focused on how the proposal would define a broker that needs to comply. The digital asset middleman category stretches the statutory language beyond its breaking point, in direct contravention of the relevant legislative history, the DeFi Education Fund argued in a comment letter. The current language of the proposal inexorably leads to the conclusion that the proposed regulations could treat every participant in the blockchain technology stack as a broker. Do we really want all of these, entities to be considered brokers, and do we want them to have to be forced to collect people's and customers and individuals' private, data and information? And the answer to that is definitely not, especially when they aren't, by the correct definition, really brokers. Because a lot of this stuff is essentially code that's sort of executing. And there's maybe a team of developers that have deployed that code, and sometimes they may not even really be involved with the protocol or project anymore. A comment from the Americans for Tax Reform says the government's scope for brokers is pursuing a broad definition that includes entities incapable of reporting the applicable transactional information. The group argued that the IRS wants to rope DeFi into the reporting regime to ensure that other entities do not convert to DeFi entities and circumvent reporting requirements. Another frequent industry concern was for investor privacy when it comes to government reporting of transactions, which crypto brokerage Coinbase argued would impose an unprecedented, unchecked, and unlimited tracking on the daily lives of Americans. According to a comment letter from Lawrence Slatkin, the company's vice president for tax, he contended that the regulations as written would allow government surveillance of the choices Americans make about their most private healthcare decisions or even when they purchase a cup of coffee. Could not agree more here with this. This is just a great breakdown and analysis, and some very legitimate points from the Web3 industry, sort of pushing back on this. This proposed legislation by bureaucrats who haven't really fully deciphered and understand the implications of what they're trying to push through here. Another interesting story I found here. Apparently, it looks like BlackRock has their own little website here. Welcome to the BlackRock site for individuals. That sounds not, something doesn't jive there, but nonetheless, let's take a look here at what they are sort of talking about. It's an interesting read, well worth a read. Kind of some of the stuff that they see driving returns. It talks about the AI revolution. We see artificial intelligence as a mega force shaping the new regime. We are overweight the AI theme in developed market stocks. Probably good decision there. Sort of looks at the market backdrop. U.S. stocks and 10-year Treasury yields both rose last week. We see investors demanding more compensation for the risks of holding long-term bonds. U.S. CPI data is in focus this week. The president of the U.S. and China will meet for a summit at a time of heightened strategic competition and tensions. The buzz about AI is getting louder, with tech shares maintaining their outperformance and major players getting ready to roll out new AI tools. We see AI as one of 5 megaforces or structural shifts that can drive returns now and in the future. We are overweight the AI theme in developed market stocks. We see the implications of AI going beyond pure technology companies, transcending sectors and geographies. See our new publication, AI, Beyond the Buzz, for detail. Shows the exponential advances here of some of the, from the past 5 years. So you can kind of get an idea here from GPT-1 to GPT-4 now. Advances in computing, hardware, and deep learning innovations, far-reaching impact. Interesting read here. And we have an assets in review section here. Select asset performance 2023 year to date and range. It talks about kind of where we're at today. I'll pull this over so you guys can see it better. Assets in review. And we can see, U.S. equities, European equities. It kind of shows the range for the year for 2023 so far. And it shows the performance year to date would be the little yellow orangey circles in the middle of the bars. It kind of shows where everything's at. Interesting here that we don't see Bitcoin or crypto assets on this chart, considering that crypto assets and Bitcoin has outperformed all of these asset categories in 2023. If you guys get a chance, give this website a little look. I think we'll put the link in the show notes. It looks like it's BlackRock.com. It looks like they have their own U.S. individual insights. See what the big boys are sort of looking at. Today we will go over some little tweets I found over the past couple days that I thought were interesting and worth just sort of looking at. Pete Rizzo here, great Bitcoiner, Bitcoin historian. He's editor for the Bitcoin magazine. He really has studied the history of Bitcoin and cryptography and some of the communities that help put Bitcoin together. And he just kind of throws up this sort of tongue-in-cheek article by somebody from 2015 by a Dan McCrum. And it shows Bitcoin's place in the long history of pyramid schemes. And it shows the price of $300. Interesting read. You can click on it and look up this article. It's just kind of interesting to read what somebody was writing a long time ago. But obviously he was misinformed with the Financial Times, which seemed to be constantly misinformed over the years. Next up, we have contrast Rizzo's sort of post with today. CZ posted this. This is probably based on only on-chain data. Please don't FOMO. Over 60,000 Bitcoin millionaires emerged in 2023, 3 times more since January. This highlights is just the idea of in this previous bull and bear cycle of Bitcoin, there were a lot more people who were sort of interested in accumulating and saw the opportunity when Bitcoin retraced its previous high from the last cycle around 20,000. Interesting little take. Next up, we have Alex Gladstein and the Human Rights Foundation. Big fans of both. Alex has put out a lot of great content over the years, a lot of great articles. Bitcoin as a Trojan Horse is one of his articles that he wrote, I think, for the Bitcoin magazine. It's a great little article, great read. I think it's called Bitcoin as a Trojan Horse for Freedom. We'll have my media team put that in the link as well to take a look at. But if you haven't yet, give him a follow, give the Human Rights Foundation a follow. They do a lot of great work for society and for the world. On November 14th, HRF will launch its CBDC tracker program at the National Press Club in Washington, D.C. The tracker will go online for the first time, providing the public with a resource to examine the progress and risks of CBDC implementation worldwide. So we can take a look over here at their website and the Human Rights Foundation. And pretty cool. Next up, we have my friend Samuel Arms here. Excited to be speaking at Bitcoin Day Naples again. We'll be discussing how Florida became one of the best states in the country for Bitcoin and how we plan to keep it that way. I'm going to give this a like and a follow here and a retweet. And I will also be speaking at Bitcoin Day. So highly suggest all you guys check it out if you can. It's here at Bitcoin Day Naples. I think there's a promo code and discount associated here with this promo code FBBBA, which is Sam's code. If we come over here, we can see Bitcoin Day. It was a great conference last year here in Naples. Food, just nice one-day conference, some great speakers. Had a blast. Sam heads the Florida Blockchain and Business Association right here. The Florida Blockchain and Business Association is a association here in Florida that my company, Consensus Protocol, is a part of. We, help craft positive legislation, crypto-friendly legislation, freedom-preserving legislation here in the state of Florida, and to try to attract, blockchain, Bitcoin, Web3 companies to the state of Florida, and to provide opportunities. I think it's been a great value so far. Sam's done a great job leading this organization. And if you're interested, you can check it out at www.fbbba.io, and we'll leave that link in the show notes. Some recent legislation, the anti-CBDC bills and stuff, that was all crafted and formulated here in the state of Florida. A lot of that legislation was copied in other states. But that's all I got for you guys today. Give us a like, give us a follow, give us a subscribe. Stay safe, stay blessed, never stop learning, and keep an open mind. Thanks for listening.